and good morning. And so thanks everyone for coming back for the 11 o'clock panel, Securing Global Supply Chains. So joining us here today, I have Matthew Boyle, Lead Analyst for Dry Bulk Gas LNG at Kpler, Dinos Demetriades, CFO and Director, Global Head of Operations at Pelagic Resources, and Vinit Lakhani, Head Base Metals Minerals at Tata International Limited. So thank you for joining us here today. And just to kick things off, I thought it would be good to have a short introduction from each of the panelists. You can tell us a little bit about yourselves and what you're currently focusing on. So Vinit, if you want to start things off.
Thanks, Amy. So I run the base metals book at Tata International. That's a commodity trading outfit within the Tata Group of India. So the mandate I have is to grow the base metals from not just into the traditional base metals spectrum, but also look at some more critical minerals across some of the more tough jurisdictions. So before joining Tata's, I've been a metals trader and a coal trader across different global trading houses, and I've also been a banker in the early part of my career. Thanks.
Yeah, hello all. So before I sort of talk about what I do, I think it's better I talk about what Kpler does. So Kpler is a data and analytics firm. We specialize primarily in vessel tracking and trade flows for oil, LNG, gas, and dry bulk. So I'm on what we call the Kpler Insight side, another one of these research companies that has insight in its name. So I am the lead analyst for LNG, gas, and dry bulks, including coal, iron ore, grains, bauxite. My background is a little bit similar to yours, except without the trading bit. So I spent some time in finance, working for Goldman Sachs. I worked for a coal mining company at the time. It was Vali. I have also worked for consulting and research houses such as Wood Mackenzie, CRU, and S&P Global Platts Analytics as well. So, 6 years in Singapore and counting. So.
Hi, good morning, everyone. I'm Dinos Demetriades. I am the CFO and COO of Pelagic Resources. I will also introduce Pelagic first. We are a niche physical trader of metal ores, especially from Southern Africa. We specialize in chrome ore, vanadium, as well as other commodities that we are sort of dipping our finger into. Now we've been around for about 5 years, and we only do physical trades. So our strategy is working with miners at an early stage, financing them to production, and basically off-taking and trading the ore. And it's been a fairly exciting ride for us, and very happy to be here in front of you today. I started off similar to everyone else. I was in finance. I was in Standard Chartered Bank project finance, doing mining deals since I started my career. Then moved into coal mining and trading, and finally chrome ore and technically chrome mining now.
All right, great. Thank you for that. And so, coming out of the COVID-19 pandemic, one of the big themes has been on, what's been happening with the global supply chains and the kind of imperative for end users to secure a reliable supply. So what sort of impacts have you all seen over the past few years, and are we coming into a better place now? Whoever wants to start.
So, no, interesting you brought it up. I mean, of course, COVID was a disruptor of sorts, not just disruption in the business world. I think socially also it's been a bit of a disruptor. But now, subsequent to COVID, we've got much bigger geopolitical disruptions. So I think what all these disruptions have shown the world over the last, let's say, 18 to 24 months is how vulnerable the global trade supply chains are, and any potential vulnerability that always existed in the supply chain, was potentially hidden because of whatever reasons, is now being exposed. And everyone knows what's happening. And because of all of this, what's happened is that not just the trade flows have got disrupted, there has been disruption in the price. Prices have dislocated between upstream and downstream. The fundamental nature of inventories, whether you're keeping inventory at the raw material stage or you're keeping inventory, somewhere in the water or somewhere at an intermediary stockpile or even at the finished goods stage. So everything, the whole dynamics has changed, and people have slowly realized that it's one, you got to have a diversified supply chain, particularly from a sourcing perspective, and two, you need to also find a way to keep it a little more agile and easily accessible, because to make matters worse, the funding cost is not what it used to be during COVID times. One of a bit of a savior during COVID times was that the funding cost was low and people could actually afford to keep a couple of months of stock at fairly low financing cost. But now with that changing, the world's heading to a lot more difficult situations. So I guess, of course, trade flows have been disrupted, very vulnerable, very exposed. They still remain exposed. But end of the day, I think we just need to understand that one, there's a diversity in the supply sources. Two, you need to ensure what sort of stocks and what sort of planning you need to keep across the supply chain. So that's my initial view.
Yeah, I tend to agree. Maybe if I just sort of pinpoint a couple of things that you sort of touched on, in particular the COVID situation. So during COVID, especially in mining, with mining companies and that, you saw obviously significant demand destruction and also production issues with lockdowns and that. A number of mines, I'm speaking more primarily from the coal side here actually, but a number of the mines in the US, in Colombia, in some other parts of the world, they shut down. And then as they started to re-emerge from COVID, that labour force had disappeared. And so it was difficult to actually get them back. You also had issues with mining equipment. So a lot of the mining equipment had been sort of retired or put out. If you needed to get new mining equipment orders, that became very difficult to get as well. So there was a long lag and delay for those too. So even if a mine wanted to ramp up production to take advantage of high commodity prices or whatever, there are barriers or limits to them being able to do that. So that has definitely had a knock-on effect over the whole supply chain. I mean, we haven't even talked about containers and shipping and what's happened with shipping as well. That was also impacted by COVID. China had sort of increased factory output in 2021. That has been the case this year. But that caused a squeeze in the container market, which ended up having a knock-on effect for the dry bulk and just tankers in general in the shipping market. So there's been a couple of other sort of factors which don't usually sort of get factored in. Usually there's planning and foresight, but because of what's happened, it's been extremely difficult.
Yeah, thanks. Well, our planning went out the window completely last year. We operate in Southern Africa, so we had problems on every single part of the chain. We had problems at the mines because every single case would cause a mining shutdown. Then we had problems with trucking because in our case, we mine chrome, but chrome's actually shipped out of Maputo in Mozambique. So crossing the border went from being a 5 to 6 hour ordeal to like a 2-day ordeal. Then you try to get rail, that was also disrupted. You reach the port, you're running out of boxes, running out of vessels. Coming into China, you don't know if you're gonna discharge. So the entire, so it was beneficial for prices, right? I have to say that. But it wasn't, we would be booking with, we would usually book with a 2-month last shipment date. Just say you have like 2 months to load your vessel. We would go up to 4 months. And the Chinese buyers were actually very comfortable with that because they understood what was going on. But it was It was not a very pleasant year. This year is a bit different because as the whole planet was emerging out of the whole COVID and I would call it the container slump. Now we have China, which is in our case the biggest buyer, with some. This is my personal opinion, so don't. This is not the company's opinion. It's got some erratic policies that we don't know. They might shut down a port tomorrow. They might shut down another city. We can't predict how that. It's not commercial decisions, and now trying to plan with such a such a wild card of a factor is making our life very, very difficult. So we had to adapt by changing the way we trade. So suddenly it becomes we trade more domestically, we trade higher valued product. We went from just trading ore and hoping that it reaches China, to selling and then trading ferrochrome, which is more expensive and can go to other markets. But definitely, I mean, it had to, most miners and traders out of Southern Africa had to transform or die last year.
And so is China still kind of the biggest barrier to getting back to normality?
No, I can't say that. I mean, it's a fairly major factor. We've got a analyst here, but you also have the dollar. You have demand out of the U.S. You have energy issues out of Europe, which are a main factor. I mean, so it's not just China is the major market when it comes to metallurgical stainless steel kind of products, but for foundry grade and chemical grade, I mean, Europe has always been a major market. Now we find the energy crisis making orders out of Europe reduce because you can ship. Can they process it? Will they process it? So it's not just China. There's multiple factors. The joy of supply chain is that it's such a complex thing. So you try to focus on all fronts at the same time, and usually the one you miss out is the one that turns out being problematic.
And how do you see things, coming out today now that we're not past COVID, but things have kind of normalized globally somewhat.
So I think, interesting. You mentioned about chrome, Dinos, because chrome is one of the products which the world is dependent to a large extent from South Africa, right? So particularly for products like chrome or certain other critical minerals which you get from Central Africa, Congo, and Rwanda, and all those other places, the problem was a little more pronounced because the world suddenly realized that, hey, I'm getting 50% of the global output from one particular region, and if that region shuts down for simple reasons, right? Simple things like documentation, export documentation, right? Things can just go very, very bad
Change
very quickly.
legislation, yeah.
So that was one of the things that certainly came out of it, and I think it's not going to change. Of course, China is a big factor, and it's the biggest consumer, the biggest producer, the biggest exporter of pretty much most of the products we can think of. So they literally, the Chinese equation controls the price to a very, very large extent for most of the commodities, at least that we deal in our spectrum. And I don't see that changing. I think we're still very, very vulnerable to those shocks, like potential, closing down of a port or some other geopolitical or social situation emerging in China. So that could have a very, very significant impact on not just on the prices, on the overall trade flows. But the fundamental thing is that the way that the supply chains have emerged over the last couple of decades, we are still extremely dependent on certain key locations for certain products. And unless that changes, I think it's going to be, we are in for shocks, every few years or every time there is some form of disruption.
Yeah, I think when it comes to China, you are right. It is such a dominant market, but I actually think that global trade is actually moving away from China as much as possible, where they can. So, for example, in iron ore, no, it's still going to be the dominant market in steel production. It's still going to be the dominant market. I think you're seeing, and it was sort of discussed a little bit earlier in the earlier panel about coal production. I mean, current coal production in China is, raw coal production is, up until August is the same as it was January to September last year. So they've basically produced an extra month's worth of coal in a shorter time. So 370 million tonnes last month. So they are moving towards self-sufficiency in coal, both met coal and thermal coal. Now, that's not good for traders of seaborne coal, obviously. So, but the reality is, when they're producing 4.5 billion tonnes of coal, why are they importing 300 million tonnes of coal per year? It's purely due to arbitrage, price arbitrage. So, and at the moment, seaborne prices are way too expensive. So you may start to see that sort of movement away. Whether or not it is policy driven or it's just circumstance or geopolitics or whatever, China does appear to be sort of moving towards self-sufficiency in a number of commodities. But iron ore, battery metals, rare earth metals, they control a lot of these markets. So they will still dominate global trade no matter which way you look at it.
I mean, there's been a growing trend, at least in terms of the discourse in the industry, is about regionalizing supply chains, especially when it comes to critical minerals and stuff. How do you see that all playing out within your industry?
Look, that's a very good thought, I'd say, at this stage, because what traders do, and I hate to admit it actually, that traders tend to take a slightly shorter term approach when it comes to trading, right? As a trader, I'll try to pick up material from the most convenient location to make a quick buck, right? And what that does is that over a period of time, it's a bit of a flock mentality. Everyone starts going to that point in the supply chain, whether that's upstream, downstream, midstream, or wherever. And what you do is you put a lot of pressure on one point in the supply chain, and that the whole supply chain gets disrupted. One example of which I can see already, there's a pressure going on. For example, if you look at lithium supply, right? So there are lithium deposits pretty much everywhere, right? It's one of the most abundant minerals found in, globally. So you've got deposits that are identified in South America, in Africa, in Australia. But what's happening is the most mine development that's happening is happening either in Australia or potentially in South America. That's about it. Africa's got a lot of deposits. There are mine developments that are happening, but what's happening right now is all of the ore, lithium ore, is flowing from Africa, from Australia to China, whereas it doesn't make sense to move African ore to China, right? Unfortunately, there's no other option because all the processing capacity exists only in Far East, right? So what's going to happen is at current prices, which are high, it'll survive. But once prices fall, then the African miners will struggle because they would have created so much of supply at that point in time and suddenly the prices don't justify shipping all of their 2, 3, 4, 5% low grade ore to China or Far East. So we're already seeing that happening, and I'm afraid there's no quick fix to it because ultimately, to set up processing capabilities, to set up facilities, you need capital, and capital is only available in jurisdictions which make sense from risk perspective. So it's a tough one, but that's always been the case. Iron ore had a similar issue, right? And iron ore is slowly trying to come out of it, but I can already see that happening in some of the critical minerals.
Yeah, I mean, no, I fully agree. I guess when it comes to critical minerals, it may also be linked to that sort of energy security issue, and also just an overall trend towards, for want of a better expression, nationalism within different countries in terms of their own strategic resources and their industrial production and that. So, so there is definitely a movement towards that in a number of sort of regions and countries, and China's definitely leading the way for that. And you look at Indonesia, and they're looking at sort of trying to sort of process more of their nickel internally.
Yeah, but it's the Chinese who are processing it.
Exactly. That's exactly right. So I was about to say. So that's exactly right. So I think everyone's trying to sort of control as much as they possibly can. And the Chinese are probably very good at that.
Yeah. But I have to say, one of the reasons was I wanted to enter this panel, it was to understand where is the US in this equation? Because we hear about independence, we're hearing that, but other than Chinese companies are the only ones actively pursuing reserve, pursuing processing, solutions, financing, and they are very, very welcome in most of these jurisdictions because no one else is showing an interest. And so most of, as I said, the processing of the critical metals is currently predominantly in South Asia, which doesn't make sense. But when it comes to setting up processing capacity in, and I want to speak just for Africa, which is the geography we understand, it's still Chinese processing plants, Chinese energy solutions, which is, I mean, if you're in Southern Africa and you depend on ESCOM for power, you will never get a processing plant out of the way. Indonesia is another example. I mean, Tsingshan basically took over an island, so they have the shipping routes, they have the easy barging of nickel, coal, power, all in that place, but it is from beginning till the end a Chinese operation, right? So I was curious, where is US in all this, right? I mean, there's a lot of talk and basically managing the dollar, etc., and their buying power, but I don't see any US entities actively trying to secure any commodities and in any jurisdiction, at least from my point of view. That's why I was curious to see your opinion on that.
Yeah, I haven't either. Maybe people in the audience can help. I haven't seen anything like that. I think the US has also been trying to be strategic with its own domestic resources. But yeah, I haven't actually seen too much investment outside either.
There's American car makers that are investing directly into spodumene producers to try to secure their supply chain. So Ford just invested $300 million in Liontown, I think. I know Tesla is doing offtakes with a bunch of companies also to try to get slightly with Piedmont, it was like a junior miner, 50 million market cap. They gave them a conditional offtake so that they could get, market acceptance, start raising money, get that whole process going. So I think, they're late to the game, very, very late to the game. But they're starting to realize that if they don't get the stuff. Also, the IRA just got passed in the US. They're talking about subsidies for battery makers or for people that purchase cars that have battery parts that are produced in the US or US related or US allies like Canada, Australia, and stuff like that. So again, very late to the game. In mining, this thing takes like 10, 15 years before they'll actually get to where they need to go to, but they're starting.
I think
That's really good to hear.
that the Inflation Reduction Act, it's all about getting domestic mining and processing and all of that for these.
Domestic isn't actually domestic. It's
Right.
Canada, the U.S., everything that's basically the idea is they're trying to take away the supply from China, or they're trying to make sure that China can't control all the supply of spodumene, which they control most of right now.
No, interesting you mentioned that because, of course, all these US has over the years emerged as a very strong sort of a downstream end product manufacturer, right? And obviously they are the fastest when it comes to new technologies, and talked about Teslas and Fords and all of these guys. They are obviously leading the game in the electric vehicles, but they figured out. You're right, quite late in the game, but they're reasonably well placed compared to the peers at least. Of course, they are late when it comes to comparing with a Chinese miner or some other miners in Australia who have obviously got an advantage in mining lithium or spodumene or whatever. But the battery maker, but it's very interesting to see a car maker going all the way back to securing lithium supplies, right? That already shows you where the disconnect is. right? Because nobody in the middle part of the supply chain is actually doing enough. And whoever is doing is, as Dinos mentioned, are very, very, concentrated. There's a very concentrated group of people who are making all these investments. And suddenly, out of the blue, the end product manufacturer has realized that, and he's actually going there and making his own direct investment. So that's a good step, I think. Another thing that I see that the US is doing a lot of is on the recycling side of things. So there's a lot of push, a very, very strong push on recycling, because typically if you look at, I'm not just talking about battery recycling, that's obviously been going on for a bit, and US is leader there. But if you look at non-ferrous, right, less than a third of aluminium is recycled, less than a third of copper is recycled. So traditionally what US and all the Western economies used to do was they used to just dump all the scrap to China, to India, to a lot of other emerging markets for them to process, sort it, segregate and process, and then get the finished products, the secondary alloys, the secondary products back into the industry. But that trend is changing. So US has actually taken a strong lead there, and along with Europe. Europe's always been good in recycling, but US is picking that up in a strong way. So what I see, and again talking about the supply chains, I see a very solid disruption happening in the next couple of years, where all of the scrap outflows out of Europe will stop, and the European companies, the American players, they will set up their own, metal, aluminum recycling plants, copper recycling plants, because traditionally scrap was considered as waste, hazardous, and something that I don't want to touch. But people have slowly started realizing the value of scrap, and all of these outflows will stop. And I mean, Houston's becoming a big hub, not just for batteries, even for setting up scrap yards and scrap processing things for other ferrous and non-ferrous stuff. So I can see a lot of disruption happening on that. India and China have been dependent on scrap from Western world, so that's going to stop. So so the whole landscape is going to change again on the recycling side of things. And obviously, over the next couple of years, potentially it'll take another 1 or 2 decades. I think the secondary production of metals is going to be hopefully it'll be 50-50 compared to primary. So that's another thing, and that's where I think the US and the Western world is leading, way ahead of the developing counterparts.
Yeah, it's interesting about the recycling bit, because when you think about it, it makes a lot of sense. That they bring it all back and they sort of do it there. I actually don't know the answer to this question, but I mean, in terms of environmental regulations associated with processing scrap and recycling, will that fit with I guess we're now talking about, what is it, COP27 coming up or whatever like that. So, I mean, so are there any hurdles or barriers in terms of bringing this sort of back into the US or into Europe?
Based on my understanding of the industry, and we've just started, the reason I mention this is because there's something that we've just started in our organization. We've started recycling and scrap trading. So look, I don't see any regulatory issue there, because for basic stuff like copper and aluminium, I don't see any issues. Of course, there are other things like batteries have got a huge pollution issue, so that needs to be managed separately. But I'm talking about pure metal recycling, right? So all the dirty job, lack of a better word, is already done in the US or in Europe, because what they are doing is they're aggregating and collecting all the scrap, shredding it, sorting it, and that's where all the dirty job happens. And they're sending like 90%, 95% aluminium or copper to different parts of the world already, right? So the heavy lifting has already happened. What they're not doing is they're just not, they're not setting up enough furnaces or secondary smelters to melt this and take the metal out of it. So I don't see a major environmental issue there, at least for basic metals. Of course, battery is a different animal altogether.
Before we continue on, do we have any questions from the audience? Happy to take them throughout the course of this panel, just to keep us on track. So, but if not, we can continue on. One of the questions that's been coming up in terms of trading is the move upstream into mining. So, is this opening up opportunities for mid tiers and juniors? How soon is too soon for traders to get involved in a mine or an exploration project? Do you see a trend?
12 months. No, it's because traders tend to have it becomes a financing game.
Yeah.
Mining is a financing game, and I don't want to speak about the entire industry because there is various different profiles. Some traders tend to have more access to liquidity, others have less access to liquidity, but overall traders tend to have more short-term money than long-term money. So going in at an early stage exploration, throwing money, hoping you're going to get like a billion-ton reserve to trade 5 years down the line, not that kind of business. But if you are 12 months and you can use one of your revolving credit facilities or short-term funds to actually do a prepayment, or in our case, as a company, we take a bit more risk because of our size. We have to take a bit more risk. We come in at the 2 to 3 year mark, where is capex of a proven reserve or a brownfield or reopening an operation. So that's where we get in. But most traders will come in 6 months or 12 months before production at most, because that's their financing. I mean, where is a trader going to find a 3-year term loan where they have a fairly weak balance sheet, but they can get a credit line which has a up to like 180 days and 360 days, and they would use that for securing the product. So in my opinion, that's the earliest. Of course, there is always like you have little private equity, throw some money here, throw some money there, just to have a bit of exposure. But the bulk of the funds come when you have them available. So that would be 12 months.
Look, I agree with you to the extent that this is what most of the traders have been doing for traditional commodities, whether it's coal or iron ore or even chrome for that matter. These are established products. You can there's a fair amount of established supply sources, established demand base, established supply chains. But when you talk about critical minerals, like lithium is one example, right? Then you've got tantalum, you've got cobalt and all that. So these are products where I expect traders to come in a little earlier, and of course, it depends on the profile of the trader. I mean, has to be, if I'm putting in $10 in a mine, I need to have, that has to be very, very, very small percentage of my overall book, right? Because this $10 is a bit of a punt, right?
Yeah.
Couple of years down the road, you may not get the required grade. Even if you get the required grade, you may not be able to ship it out. Even if you ship it out, it may not work on the pricing side, right? But I think for critical minerals, and I'm already seeing that, I can already see some traders getting into tough jurisdictions. Tin is a very classic example, right? If we saw one of the largest tin mines in the world developed in Congo in front of our eyes in the last 5-6 years, Alpha Min, right? So a trader had put in significant equity capital in that a few years ago in a jurisdiction like Congo, right in the middle of Congo. And I'm actually very pleased to see that they have come up and the projects developed very well. And Alpha Min's developed as one of the largest singles place sort of tin mines globally. So I can see the trend changing for critical minerals. But yes, you're spot on. For more established products, it's not worth taking that kind of a risk.
On the critical minerals front, is this new perceived supply shortage that we're talking about in kind of the key battery metals, is that impacting
Oh no,
people's
absolutely,
willingness
yes.
to get in earlier?
Absolutely, that's impacting, and my worry is that suddenly in the next 12 to 18 months, far too much money will flow into mining rather than processing, right? And that will create another problem in the next 5 years. That one part of your supply chain, as I earlier mentioned, is going to get clogged, right? Too much pressure on one part of the supply chain.
Dinos, earlier you brought up, in terms of looking at your time frame, about risks. So how do you assess these risks?
Okay, that's a big question, right? And going back to what Vinit was saying about critical metals and getting in early on, there's okay, let's look at something like lithium, right? You don't want to be chasing a bubble. There is so much lithium on the planet, right? I remember being in I think it was a one-to-one conference. There was Robert Friedland, the head of Ivanhoe, that said that honestly there is one mine in, I don't remember the country, that could supply the entire planet's requirements of lithium for the next 100 years, which is true. Which is true. So a you have a lack of production, lack of processing, excess demand, but then you're trying to get into lithium. By the time you get into it, maybe there's an excess. So as a trader, do you really want to take that type of risk? So the way we assess it is, I would say, okay, the further away, the higher the risk. I mean, that's a very simplistic view, and the less money you risk at it. But you have to risk it. I mean, you can just avoid it. If you remain in the short term, 12 to 6 month game, let's say, and you're competing with, it no longer becomes a trading game, becomes a financing game. You borrow at 10%, they borrow at 50 basis points. Who's gonna have easier access to short term? So yeah, so we spend a great deal of our time and a lot of our resources on actual geologists and a lot of local lobbying of understanding local community issues, because it's not just the reserve. I mean, there's reserve in most of Africa. There's an abundance of resources, but you need like supportive local communities, local infrastructure. Um, that's where we try to get as much information at an early stage as possible, and um, and and then hope we do the right, should make the right choice, really. But we got half of them right so far, so more than half. So we must be going okay. Yeah.
I think I'd like to add one more point. I think capital, of course, is a risk. Obviously, when you have to deploy capital, you have to be careful, right? One of the major risks I see in critical minerals, and obviously everyone's talking about lithium, so let's stick to that as an example, is how do I price it? If I put some capital in a mine at an early stage as a trader, right, and that mine's going to come up in, let's say, 2, 3, 4, 5 years, how do I actually price the product? Because there's such a disconnect between the ore price and the finished product price, and there are no real indices that are available to actually help me price the product. Because if I'm investing in a mine, I've got one objective, which is to secure offtakes, right? Secure supply. If I can't price it, then it becomes a lot more challenging. One of the I'd say you can compare it with how copper market developed, right? From copper ore to concentrate to refined copper. So the whole treatment charges, refining charges, TCRC concept developed. It took a while to develop, but now it's a more established product, right? I think something similar to that has to happen in critical minerals as well, whether it's lithium or it's cobalt. Otherwise, it's the price difference between the finished product. Let's say lithium's trading at lithium carbonate or hydroxide $70,000. Ore is probably 6% ore is maybe at $1,000 to $2,000. So there's a huge disconnect between the ore price and the finished product prices. So unless a little bit of a pricing index gets established, it's very difficult for traders to take. Even if I have capital, I'm still thinking, how do I actually price it? How do I commercially evaluate this opportunity?
Yes. And substitutes, right?
Oh, yeah,
So
yeah, exactly. Yeah.
I mean, lithium is, what people say, lithium is a technology, right? So it's a type of battery. There is others, graphite base, carbon nano, whatever. I mean, when I read an article, all these other technologies, which are like, is lithium really gonna be the only, the most crucial commodity when it comes to batteries? Or, as I said, we're looking at vanadium, and there is an argument that vanadium redox batteries are better for grid. So if you want power storage solution for a grid in a city, it makes more sense to use vanadium redox battery rather than a collection of small lithium cells. So Yeah, you're right. I mean, how are you going to price it? Maybe there's just so much lithium 10 years later, and batteries and cars move to a different technology that we might not be aware of currently. What do, right? The only certain part up until that point is how much money you spend in your investment. And yeah, as a trader, you would rather see someone else take that risk.
So that's a little counterintuitive at this stage, right? It's tough to evaluate mines from a long-term perspective, but you still see more money being poured into the mining side of lithium, at least, right? Whereas people should be putting money into processing plants, given so much lithium is around,
Yeah.
right? You need more processing plants, in different locations to be able to process whatever lithium's available wherever.
Yeah.
So it's a
But
little counterintuitive.
yeah, it is, and again, I don't have the answer to this. That's why I'm trying to get it. So is this funding coming from actual traders though, or is it funding coming from the capital markets, listed entities, or like hedge funds that they want to ride the wave and they want to see a valuation, and there's the name lithium in a mining company exploration stage, maybe it attracts more of a premium than someone who's going to be like in coal trading, even though the coal traders are like they're really milking money this year, right?
I don't think traders are putting in much,
Yeah, so
much money.
it's financial money that goes into
I
lithium.
don't think it's financial either. I think it's mostly coming from end users of products like Tesla's already putting money in there. A lot of Chinese battery makers are getting into putting money into lithium. Like I think Pilbara Minerals has signed up a big offtake with a large Chinese producer of batteries, right? So the end users are pouring in money. I think it's still a little too exotic for financial markets to look at it, I guess.
So, in some of the companies we've been looking at investing in, we've seen Glencore and Trafigura come in with 60-month time horizons, so 5 years, sometimes 3 years. I know Trafigura was looking very heavily at nickel from Indonesia. Glencore offered a 50 million 60-month to a copper company in Australia. So there is some interest. I mean, I don't know how that's going to change with interest rates rising and stuff. My opinion is that was probably an effect of the extremely low borrowing costs that they had, so they could take higher risks as a result of that. But they were making these big bets. So actually, one of the questions that I had was, is it? I mean, how do you, as a trader that might not be the size of Glencore or Trafigura, how do you compete with something like that? Are there opportunities that are going to be good opportunities that they don't see? If you could help with that.
Well, yeah, funny you mentioned that, but that's exactly the case. So in Chrome, the largest trader, I think the second largest trader is Glencore. So we are technically directly competing with them. The only way you can compete is just by taking more risk. So we deal with smaller miners. We deal with smaller operations. We deal with riskier jurisdictions because you can compete on financing, and you can't compete on cost of operation, because it's not just financing the product. I mean, when it comes to us shipping, we take spot rates, or maybe we take a time charter. They have vessels, so when it comes to processing, or so not processing, actually moving the product, loading it at the port, we use access. Access used to be a so you are the only way you can compete with that and maintain your business is, I think, is the way we're doing it. We take more risk, but we secure offtakes for as long as we can. So we get into, that's why we ended up being in the ownership of mining of mines and reserves, because if we had to compete for offtakes with the larger producers, like we competed against, we saw that if we're competing for short-term offtakes, like 1 year offtakes or spot cargo, it's Gunvor is there, Glencore is always there, Trafi not so much in what we do, but you basically have to get your own mine if you're going to be competing with that. Suddenly you become relevant. But again, it's you're smaller, you're taking more risk with more expensive money. Yeah, it's a stressful business, but it's the only way it can be done.
I think yes, of course. The smaller, more niche traders have to take additional risks to get the same level of product which established companies have. Right? Of course, their working capital, their cost of capital is much lower than smaller traders' cost of capital. I think for a mid-sized trader like ourselves, we'd like to think it slightly differently. Of course, if you can't control the supply side, fine. Even if I take additional risk, I'm still getting the same amount of output, right? Which the other guy's getting. I'm getting it slightly more expensive because my financing cost is higher. I have to look at the other side of the trade. So I need to get my buyers closer to me and manage the buy side of things, because ultimately you can have all the supply security in the world, but if you cannot have if you cannot control your buyers, meaning you're supplying other products to the buyers, right? So you add this new product to the mix, or you can extend some credit to the buyer side of things, right? And that's only possible if you're more local, right? I don't think large traders can go to anywhere in the world and just extend credit to a buyer. So if you're local, let's say we are an Indian headquartered trading house, we've got global operation, but still, we've got a home market in India, and we are in a position to manage the buyer base, whether it's a cobalt or a copper or a chrome or anything, right? It doesn't matter, but we are in a much better position to manage the buyer side of things. So ultimately, each trading outfit has to find their own niches, right? Whether it's on the supply side, on the financing side, or on the end customer side.
Any other questions? We're getting close to the end of the hour, Mark. So I think maybe we can just start to wrap it up with just kind of a closing thoughts on where you think the industry is going, how you see kind of the future of the financing for the industry, what's happening with the supply chains moving forward.
It's tough to
Summarize.
tough to summarize. I think, frankly, I think the supply chains, at least in the near term, will continue to remain vulnerable and exposed to shocks. We can't help it. That's just a systemic sort of thing that's built in the supply chains. What we can possibly do is try to sort of spread across the supply chain and have a little more diversified supply source. That's one. Two, and I think a little bit of discipline. That is what it takes. Right now, I think it's a good time to have that disciplined approach because cost of financing is higher. And in earlier days, traders would just buy tons and tons and tons of material and sell it over a period of time, warehouse it somewhere. They can't do that. So now, like they say, necessity is the mother of invention. So now they have huge working capital costs. So they will have to find smarter ways to manage the supply chain. I hope because of this, something good comes out of it, and we get a little more balanced supply chain rather than everyone flocking to one, either to the mining side or to the processing side. So.
Yeah, couldn't agree more. Because the number of economic headwinds that we're currently seeing at the moment is going to cause some grief, in particular as we move into next year. In many ways, due to what's happened with COVID and sort of, the fact that, 2020, a lot of the commodity markets were price-wise in the doldrums. So there has been somewhat a little bit of an overcorrection in terms of companies trying to sort of reclaim some of those losses. That's obviously contributed to inflationary pressure and high energy prices. And so what, throwing geopolitics into that, then there's still going to be a lot more headwinds sort of coming forward. So, but that said, let's hope that sort of the markets return to some sort of balance and some sort of normality because, sort of there was no reason why commodity prices were so low back in 2020. There's probably little fundamental reason why some commodity prices are so high at this current moment. So let's hope that they do return to some sort of balance and the supply chain issues that are evident do start to sort of normalise, which we believe should sort of happen from end of next year, 2023, beginning of 2024.
So as Vinit said, there's still going to be, it's a supply chain, global supply chain is and will remain vulnerable going forward. The way we see it, the only way you can deal with supply chain disruptions is dealing with as little of it as possible. So we see local trades, local processing, focusing on local demand as being main themes in they've been themes in the past, but becoming more major themes in the future, and as well as finding ways of securing, which is counter to, as I said, trying to get as close to the source as possible to secure. But not just source. I mean, source processing, trying to get as much of that supply chain under your control as possible, while having as little exposure to the global supply chain, which is outside your control. Because I mean, we don't want to be thinking negatively, but the whole global supply chain is at one missile away from being disrupted again right now.
It's a nice thought to end to end on. Thank you to our panelists for sharing their insights with us today. So thanks to Matthew, Dinos, and Vinit for joining us.